Kathryn, what do you make about tech starting to lead this market again?
Well, one of our guests on the panel said the U.S. is a basket case. It's a pretty resilient basket case, right? I agree. Policymaking has been.
Is that even possible? What is a resilient basket case? Well, I guess it makes sense.
Exactly. No, I'm respectfully trying to push back on that because I really do think that the resiliency underlying the fundamentals has been there, and that's why you've had retail guys getting off the sidelines, putting their cash to work when you see the buy the dip, which really has played out this year. In fact, at StoneX, one of our biggest calls and probably our best call after gold this year was to go long at the peak of the tariff meltdown. And that's when the market is collapsing based on fear. And so we went long biotech and banks, actually, and that call since April 7th is up double digits. So right now what I'm looking at is I'm looking at playing the defensives because the equities market is back on track and moving higher. I am very much more bullish than I think a lot of people are with respect to, and have been since day one, I'm proud to say, with regard to the geopolitical risk to oil prices. I had a piece out yesterday that called the oil price shock that wasn't. The Strait of Hormuz was, in my view, not going to be shut down, and probably never will be. It was the Iranian reaction was a far cry from that level of escalation, that catastrophic Armageddon type of escalation that would take oil prices potentially to 150 plus, and would derail the U.S. and global economies. So I'm generally more bullish. I do like, however, to protect positions. And what I'm telling our clients right now is when you have return to risk, when you have the VIX falling, that's when you want to buy put options on your tech positions. Tech could move higher. I think you want to look at put options, and I think you want to look at second derivatives to the tech trade, which was our top performing recommendation last year, utilities, and I think we want to look at real estate industrial complex as a second derivative as well.
Kathryn, you're always, of course, clued into all things economy. Is the consumer in good enough shape where a company like Nike could surprise to the upside?
Yeah, look, I think that consumer discretionary really depends a lot on a couple of things from an economist perspective. One, job security, and two, wages. So both are still looking pretty good. So, and in addition to that, I'll add one other thing. We look at the Conference Board and the University of Michigan Consumer Confidence. Both took a tremendous dive during the tariff chaos, and have both subsequently rebounded in such a material way that, at least for me, and I believe for the entire street, we had big sell side shops calling for above 50, 60% recession risks. That's terrible for discretionary spending. Why buy the expensive Nikes when you could buy the cheaper whatever brand X? So I think that there could be opportunities in discretionary, especially when we see shocks to confidence that are not based on fundamentals. At this point in the economic cycle, and if the Fed does start to react to the downside in terms of rates, I think we could get a steady Eddie type of economy in 2025 going into 26 without too much disruption. So I am looking for value. However, I don't see value in the discretionary space right now in terms of broad sectors. What I prefer instead is, if you're already long tech, which everyone generally is, if you're even in the S&P 500, protect those positions with defensive ones. So I'm talking about hedging risk, not liquidating tech, not liquidating your S&P holdings, hedging it with the purchase of, for example, underperforming defensives or even defense sectors, defensives and defense. I'm talking healthcare, I'm talking weapon manufacturers, I'm talking not just in the US, in Europe, in Asia. This is an industry that I believe is right now undergoing intense investment, spending, and likely to increase going forward.